Good afternoon, everyone. I would like to thank you for attending Tax Talk Time, the Big Beautiful Bill Edition. And this will cover how the recent tax bill will affect your tax filings this year. My name is Kendra Dunstan, and I'm the Development External Affairs Coordinator here at Build Up Justice NYC. If you've been with us before or saw the flyer for this event, you may notice something a little different. We used to be Brooklyn Legal Services Corporation A, and we are now Build Up Justice NYC. Although we have a different name, we're still the same exact organization. We just launched our new brand as of July 1st, and it better captures our mission and vision, which is consistent. Build Up Justice New York City believes that all New Yorkers should have equal access to legal services to seek justice, make their voices heard, and overcome systemic racism and oppression. We were established in 1968 as part of the war on poverty, and we believe attorneys have a critical role to play in combating poverty, inequity, and racism. Excuse me. While we were originally founded to serve Brooklyn neighborhoods, hence the old name, we provide free civil legal services to New Yorkers citywide in all 5 boroughs. Our civil legal services, organizing efforts, and educational resources assist our clients and their communities in defending and mobilizing against harassment, displacement, and gentrification, and asserting their rights. Today's program is brought to you from our Consumer Economic Advocacy Program, or CEA. This is where they prevent foreclosures and defend against predatory lending. They also resolve tax issues with the IRS for low-income taxpayers and strive to ensure that vulnerable groups have strong safeguards in place to help them build and maintain assets throughout their financial lives. Additionally, under the CEA program, we have a domestic violence unit that offers assistance with orders of protection, child custody and support, and more. Our newest practice area is wills and estates, and this is where we can help you protect your assets and legacy. These services range from assistance and advice in drafting wills and advance directives to preparing probate and administration petitions and educating the public on basic surrogate court processes with the goal of preserving family and community wealth for future generations. Our other 2 practice areas are the Preserving Affordable Housing Program, or PAH. This is where we help tenants with eviction prevention, anti-harassment claims, fair housing, repairs and essential services, and tenant organizing efforts. And then we also have our Community Economic Development Program, or CED. Here's we help small businesses with commercial lease matters, advice on laws and options. We help negotiate rent and arrears. We protect against commercial tenant harassment, and we also help nonprofit and corporation startup services. So with that, I would like to introduce our presenters this today. First, I'd like to introduce Liliko Chung. I am pleased to introduce Liloko. Oh my goodness, I'm sorry. And she is an intern with our Consumer Economic Advocacy Unit this summer. She is a rising second-year student at the Maurice A. Dean School of Law at Hofstra University, where she is focused on building the skills needed to create a more inclusive and equitable legal landscape. Before law school, she earned her bachelor's in human biology with minors in psychology and mathematics from Hunter College. Well, next we have Albert Kim, who joins us from the Elizabeth Hall School of Law at Pace University, where he's entering his final year. Albert is passionate about the interconnected nature of the law and has enjoyed exploring a range of legal disciplines. At Build Up Justice NYC this summer, he has worked with clients on mortgage foreclosure defense, and tax resolution matters. And we have Daya Devlin. And she is also entering her final year at Fordham University School of Law. Her academic interests center around the legal treatment of debt, and this summer she has supported clients navigating bankruptcy, foreclosure defense, and tax disputes with both state and federal agencies. They are both managed by Director of Consumer Economic Advocacy Program, Tamara Del Carmen, and Senior Program Coordinator, Serena Sankala, who are both experts in the tax world and will be available to answer any questions you may have. So with that, we are just about to get ready to get started. And I do want to let you know that we will have a Q&A at the end of the webinar. You will be able to type your questions in the Q&A box or the chat box that you see on your screen. And once we open the floor to questions, you can either chat your questions, or you can use the little hand raise button on your screen. And at that time, I will unmute you and you can ask the experts your questions directly. At the end, we'll leave you with some contact information. And if we're not able to get to all of the questions, or you have really specific questions that you need to speak to someone about, we'll make sure we get back to you. So with that, I will turn it over to Dea.
Thank you, Kendra, and welcome everyone to this talk. As you know, we are here to talk about the One Big Beautiful Bill Act, what it is, and how that affects you. As a brief overview, I'll just tell you what the day will look like. We are going to start by talking about what the One Big Beautiful Bill Act is and why it was passed. Then we'll discuss some of the broader changes it will have on big programs such as Medicaid and SNAP. And then we'll turn to some of the specific measures that will change how you will file your taxes in this year and upcoming years. So, the One Big Beautiful Bill Act, what is it? This is a piece of legislation that was passed by Congress and signed into law by President Donald Trump on July 4th of this year. At a high level, the One Big Beautiful Bill Act governs domestic policies surrounding government spending. This doesn't sound intuitive. The tax law deals with the money that the government collects, right? However, legislation that orders how taxes can be collected does deal with government spending, because the government, in effect of spending money when it provides tax incentives or tax breaks on certain activities, is spending money. For example, a deduction or a credit that you might take on your taxes will reduce your tax liability and sometimes entitle you to a refund, which is essentially a government expense. And as my colleagues will discuss further on in the presentation, this bill includes some major changes to the tax law, which President Trump advocated for during his 2024 presidential campaign, such as providing tax exemptions for overtime pay and tips. So, moving on, why was it introduced? This bill, like other pieces of tax law, was passed through a special process called budget reconciliation. Budget reconciliation is a special process that allows Congress to make the passage of budget-related laws easier without some of the challenging voting requirements that typically are needed in order to pass new laws. Because of this, what can be put into law must relate to the federal spending budget and can't be used to implement broad policy changes. Additionally, because of this process, many provisions established in tax bills sunset or expire, typically within a 10-year window. So why am I getting into the nitty-gritty and the process of how this bill was made? Essentially, because it's helpful to understand why tax law is unique and constantly changing. Unlike a criminal law, such as criminal trespass, the tax bills and laws that we have in place will expire. Criminal trespass law won't expire in 10 years. Later on, my co-presenters will identify the way that the One Big Beautiful Bill Act changes, supplements, and removes provisions of existing tax laws, including the original tax code, as well as later bills that are doing the same thing that this bill is doing, which tells us how certain activities must be taxed. So the last piece of major tax legislation passed by Congress was the Tax Cuts and Jobs Act of 2017, which had many provisions that were set to expire at the end of 2025. And the One Big Beautiful Bill Act has made some of these provisions permanent, it's repealed others, and it's provided new provisions. Additionally, this bill reflects some of the broader efforts by Republicans to incentivize investments into the US economy, fund immigration and border enforcement measures, as well as reduce waste, fraud, and abuse in the US government. I'm now going to pass it off to my co-panelist, Lilico.
Thank you, Dea. And in this presentation, as Dea had previously talked about, we're going to be covering specifically the changes in Medicaid, SNAP, also known as Supplemental Nutritional Assistance Program, formerly known as food stamps, senior bonus deduction, student loans, dependent care assistance programs, child and dependent care tax credits, changes to the Affordable Care Act, and various line item changes. Next slide, please. So firstly, we'll be talking about Medicaid. Medicaid is funded by both the state and the federal government. And when there are any kind of budget cuts, it will inevitably impact the amount of funding there will be for Medicaid. Medicaid is designed for low-income individuals and families, including children, pregnant women, elderly individuals, and people with disabilities. With this new bill, it is estimated to have a $1 trillion budget cut, and it's projected to have about 11.8 million people lose health insurance by 2034. The specific changes in terms of Medicaid are that certain requirements have changed, meaning that the requirement is now increased to 80 hours per month for the work requirement for adults without children, 14 or under, or disabled. And no longer included in the eligibility for qualified immigrants are refugees, individuals granted asylum, certain abused spouses and children, and trafficking victims. In addition, the cost sharing increases up to about $35 per service for adults. With that said, the rules for payment to states have changed, and the reduction in existing provider taxes decreases annually, and the requirement to conduct eligibility is done more frequently. So instead of the requirements being reviewed annually, it's reviewed every 6 months. Next slide, please. Next, we'll be talking about SNAP, the Supplemental Nutritional Assistance Program, formerly known as food stamps. With this new act, it is projected to cause about 2.3 million families to lose some or all of their SNAP benefits. On average, that would mean that families would lose about $146 per month in SNAP support. The projected funding that's estimated to be cut is about 20%, so about $186 billion. And that is all estimated by 2034. With that said, in addition, similar to Medicaid, the changes to the requirements for SNAP eligibility have changed. The requirements are now individuals aged 55 to 64 and parents of minor children aged 14 and up and veterans. And this is now only available for US citizens and lawful permanent residents. Next slide, please. Next, we will be talking about senior bonus deduction. With this new bill, this is an addition that seniors are now eligible for. Seniors are defined as individuals who are age 65 and older. Senior tax deduction is set to be in place between 2025 and 2028. And this would mean that seniors who are eligible for the senior bonus deduction can receive about a $6,000 deduction, and it would be available for individuals who have a gross annual income of $75,000. And it would be double, so $12,000 deduction if married and filed jointly. And that would also mean that your joint income would be double $75K, which is $150,000. And this would be phasing out taxpayers with incomes above those thresholds. So above, if you're filing jointly with your partner, it would be above $150,000 as a gross annual income. And if you're filing individually, it would be $75,000. Next slide, please. So now we're going to talk about student loans. There have been a couple of changes that have been discussed in terms of student loans, where mostly the main change is that there are now caps in terms of unsubsidized student loans. And that applies for both undergraduate, graduate, and those pursuing professional degrees like my colleagues and I. There is also now a new placement for a cap on parents who are borrowing for their for students on behalf of the students. So this would be the Federal Parent Plus loan program. And there have been changes based off of those loan payments, and it would be the changes that have been applied are now also reflected through the repayment options, which are now limited to two, which would be one of them would be the standard repayment plan, which is fixed payments not related to your income. And then the second would be income-based repayment plans, also known as RAP or repayment assistance plan. And this would start around mid to 2026. Next, we're going to be talking about changes to dependent care. So there are two types of programs or credits that are the major changes that we need to discuss. One of them being the Dependent Care Assistance Program. And what it does is it allows employees to set aside pre-tax dollars to be eligible for dependent care services. So what that means is that it allows parents to set aside certain money, a certain amount of money to pay for childcare. And it is up to their employer to, and it's offered by their employer for flexible spending account. And how it's changed from how it's been previously done is that now the tax exclusion has increased from 5,000 to 7,500. And that would mean that it would be 3,750 if you are married but filing separately. And this is effective in 2026. And the next thing we will be talking about is child and dependent care tax credit. What this means is that it allows a certain percentage of qualifying expenses as a tax credit. And this allows parents to claim their child care expenses. And it increases the maximum tax credit from 35% to 50%. And it allows this is inclusive for taxpayers making $0 to $15,000 in adjusted gross income. Lastly, we'll be discussing the changes that are affecting the Affordable Care Act. So the Affordable Care Act and the Patient Protection Program have instituted a premium tax credit that helps individuals who are not eligible for neither Medicaid nor Medicare. And it helps them afford the medication or whatever kind of health benefit they may need. And some changes that are going to be occurring for the tax years of 2025 or after December 31st of 2025 is that the Affordable Care Act premium tax will no longer be available for non-US residents and with a household income below the federal poverty line. And they also must not be eligible for Medicaid. After that, for the tax year of after December 31st, 2027, this will also now exclude certain non-US citizens, but are lawfully present in the United States. And they have to fail to satisfy certain immigration requirements. And there will now be an annual verification of that individual's eligibility. And I will be switching it over to Albert.
Thank you, Lilico. So the new tax bill has also modified certain line items that will affect one's tax return. Tax rates and tax brackets that were set to expire are now permanent. The standard deduction will increase in 2025 and will be adjusted for inflation thereafter. So if you're married and filing jointly, you'll be permitted a deduction of $31,500. If you're head of household, you'll be permitted a deduction of $23,625. And if you're single, you will be permitted a deduction of $15,750. Next slide, please. So various changes are also coming to property-related deductions, such as state and local tax deductions and mortgage-related deductions. So what is SALT? Now, SALT is comprised of state and local income tax, state and local real estate tax, and state and local personal property tax. So for those who choose to itemize their deductions, state and local taxes will be permitted a deduction up to $40,000 through 2029. The deduction limit will then fall back to $10,000 in 2030. So be on the lookout for 2030. Mortgage insurance premiums will also be an eligible deduction starting 2026. Also, the $750,000 principal limit for the mortgage interest deduction is now permanent. So for example, if you have a $900,000 loan, only $750,000 qualifies, which is approximately 83.3%. And that determines the proportion of the mortgage interest that is deductible, which would be 83.3%. Next slide, please. The child tax credit is now permanent and increased to $2,200 per child in 2025, which will also be adjusted for inflation thereafter. It will require the Social Security number for the claimant parent, at least one parent if married and filing jointly. And it will also require the Social Security number for the qualifying child or children. Under current law, only the Social Security number for the child is only required. So the requirements have become more stringent. The bill also restores educator expenses as an eligible itemized deduction, which includes unreimbursed books, supplies, and computer purchases made by teachers, principals, and other instructors. Excuse me. Next slide, please. So we have a few new line items with the new bill. So no tax on tips. So up to $25,000 of tip income will be deductible for individuals in quote customarily tipped industries. This will be applicable for the tax years 2025 to 2028. And this deduction will be available whether you use the standard deduction or whether you itemize. Additionally, no tax on the premium portion of your overtime compensation will go into effect. So up to $12,500 or $25,000 if you're filing jointly of the premium portion of overtime compensation will be deductible, whether you itemize or use a standard deduction for these 3 years. So for example, if you're making $20 per hour and your overtime pay is $30 per hour, only the incremental $10 portion on that overtime pay is deductible. Lastly, there will be no tax on qualifying auto loans. Excuse me, the interest on qualifying auto loans. So it will be deductible for itemizers and non-itemizers for new automobiles with final assembly in the United States for the tax years 2025 to 2028. That deduction is also limited to $10,000, and that phases out when your income exceeds $100,000 for single filers and $200,000 for joint filers. So interesting, I guess, to encourage people to purchase U.S. automobiles. Has that kind of effect. Next slide, please. Thank you. And finally, there will be a new type of savings account. This incentive will be created that includes a $1,000 government deposit for children born from 2025 to 2028. It allows a taxpayer to contribute up to $5,000 a year that can grow tax-free until the beneficiary turns 18 years old, at which point the account will convert to an IRA. The various other conditions will apply, and which will be further detailed by the U.S. Treasury. Yeah, thank you.
And I'll grab the microphone back. I think that we have a good sense now of some of the big and maybe the more specific line item changes that the bill has brought. But we also thought it was important to highlight some of the other changes to tax and tax law that have unfolded in recent months. The first is that ICE and the IRS has recently reached an agreement where ICE can now access information that is provided on tax returns. This includes immigration status. So it is something that is worth being mindful of. Additionally, the IRS workforce has been reduced at a number ranging between 25 to 40% since President Trump took office at the beginning of this year. So if you need to call the IRS, you might not have a great shot at getting through to them. In the last year, the IRS reported that they answered 87% of 9 million calls that were made to their offices. And they estimate that in this upcoming year, they will only be able to answer between 11 and 15% of calls. Finally, tariffs. That's in the news a lot. They're changing constantly. Tariffs are fees collected by the federal government for importing certain products. They raise the cost of doing business with companies or manufacturers that operate outside of the United States. President Trump has been imposing tariffs, which are also known as taxes, on imports from certain countries, which may change the cost and accessibility of certain goods. It's possible that with tariffs in ongoing effect, Americans can expect to pay more for groceries, shoes, clothing, household necessities, auto parts, or other items. I was reading yesterday that we get a lot of our jeans from Egypt. So things like that might have additional costs or become more expensive. And if you're wondering why, you now know. To close it off, the One Big Beautiful Bill Act has created some big changes in the existing tax system. Unlike other areas of law, tax impacts us every day. We hope that this presentation provided some understanding into some of the major changes, as well as the more nuanced or detailed changes that you may have to consider while preparing and filing your tax returns, as well as accessing medical care or supplemental assistance for food. If you have questions, Build Up Justice New York City is here to help. And I
Thank you
think
so
we can
much.
now open the floor to questions. Yeah, I'll pass it back to you, Kendra.
Awesome. Thank you so much, everyone, for your presentation, all the information. Now, we are just about to open up the floor for questions. And before I do, I want to just make sure you know that we do have a bi-weekly tax table where you are able to drop in for 15 minutes and speak to an expert from Build Up Justice NYC and our partners at Grow Brooklyn. If you received any notices, have any particular questions about your specific tax situation, you can feel free to register, and you can just register by either scanning that code if you're on a computer and using your phone, or you can visit bit.ly/tax talk Thursdays, and you'll be able to reserve a spot for yourself. And we will also be sending out all of this information after the webinar, along with the slides, this flyer, and a recording to this webinar. So with that, I will now open up the floor for any questions. Feel free to drop your questions in the chat or raise your hand, and I will unmute you. You can ask your questions directly. All right. Farhan, I do see your request, and will do. Everyone, I will be sending these over to you shortly. And so we do have a couple of other questions while we are waiting. And this is in any Daya, Liliko, or Albert, please jump in. First question is, who can claim the additional deduction of $6,000 for seniors?
I can answer that one.
Sure.
So as mentioned during the slide, seniors are defined as people who are or individuals who are age 65 and older, and that is one requirement in order to claim that additional deduction of $6,000. They must also be a taxpayer, so they must also include like social security number of the qualifying individual on the return. And if you file jointly it's not just $6,000, it's going to be $12,000, but you also have to hit that you have to hit the cap for the modified adjusted gross income of 75,000, and if it's joint, it's 150,000.
Okay, thank you. And we see Johnny Rivera has a question. What happening to mentioning the tax breaks for the super wealthy and their impact?
Yeah, I'm happy to jump in here. So our presentation was focused mostly on the impacts that this bill will have on low to moderate income individuals and families. But a lot of the things that we mentioned will have some impacts in a different way for higher income individuals. The permanent extension of individual income rates, and I'm just looking off screen at my notes. They are favorable for higher income individuals. They've changed the corporate, or actually they've made the corporate tax rate permanent, which is also favorable for high earning corporations. The increased SALT deduction cap is also beneficial for those with high incomes. But our purpose in presenting this information was for people to understand how they would be able to take advantage or adjust some of their behaviors for tax preparation in further years. Thanks for the question.
Thank you, Dea, and thank you, Johnny, for the question. Absolutely. So another question we have, what other impact does the big beautiful bill have on existing tax credits?
Yeah, I can jump here. So the child tax credit will make permanent the existing requirement that the child have a social security number. And it will also impose a requirement that the parent also have a social security number. So making the requirements a little bit tighter, this could potentially negatively or adversely affect people who unfortunately do not have social security numbers. The premium tax credit as well has changed their eligibility requirements, as Liliko discussed, and that could also put adverse pressure on immigrant communities. Thank you for your question.
Thank you, Albert. And I do have one more question regarding that new deposit for newborns. Does an individual have to do anything to receive that $1,000 deposit when they have a child, or should they prepare before the child is born? Do they have to do anything to receive the $1,000?
Yeah, Kendra, I can answer that. I think we need to wait for some additional guidance from the U.S. Treasury. But from the research that we've done, it appears that any child that's born that is a U.S. citizen between the years of 2025 and 2028 will be eligible for this special account, and the government will deposit $1,000 accordingly. So yeah, we're looking forward to hearing more about that.
Awesome, thank you. And then we have one more question. I have a question about taxes. About 3 or 4 years now, I have been back and forth with the IRS with someone claiming my child. Now I am a survivor and my child lives with me, and there is no visits or anything. I have an I-10. There is a navigator on the case, but I feel like nothing's happening. What should I do? Now, go ahead, Daya, if you're prepared for this one.
So it sounds like a perfect question for us to advise you on, maybe over a phone call or email follow-up after this webinar. I think that Build Up Justice is definitely the place to assist in these kinds of issues.
Absolutely. Thank you, Daya. I just dropped our information email. I know your question came through anonymously, which is perfectly fine, but I would recommend you email us. And I'm sorry, I put the wrong email. It is info@buj.org. That email I put will also work, but please email us your question at info@buj.org, and we will make sure your question gets addressed and answered by one of our techs and a
And
text.
sorry about that frustration with the back and forth with the IRS. It's never fun.
Never fun, but we are here to help. If we don't have any additional questions, with that, I'm just going to, we have the info@buj.org up here. Our phone number, if you're more comfortable placing a phone call, you feel free to give us a call at 718-487-2300. And I just want to say thank you for joining us today. If you have any additional questions regarding any of your tax situations or any of our other program services we offer, please feel free to reach out to us anytime. And Albert, Liliko, Daya, do you have any last words?
Thanks so much. I'm around I can stick around to answer questions, or feel free to email, and happy to answer questions further on. Thanks for having me.
Thanks for
Thank
having me. It was a
you.
pleasure to be here. Look forward to hearing from anybody with additional questions. Thank you.
All righty. Thank you all so much and have a wonderful day. I want to thank all of our panelists. I appreciate your work and your knowledge and skills, and good luck in the upcoming year. And we look forward to seeing you soon.